open the document. Yeah, previous day, we completed the balance part of investment, the balance part of the business income. Basically, the investment income we completed. Then thereafter, we moved to the business income. Then thereafter, we covered the section 12 to 19 of the Inland Revenue Act. Section 12 to 19 of the Inland Revenue Act. Those are the special sections. Some of those things gives special allowables, while in certain cases there are some conditions also. Especially in interest expenditure, there's a condition in section 18. Right. Now, we learned section 12 to 19 that day. There we said interest is allowable under section 12. Interest is allowable only if that particular loan is utilized for the business. If it is not utilized for the business, that particular interest is not allowable. Then we discussed about the trading stocks. Trading stock, this is as we discussed, this is the usual working account of a profit and loss account. In the profit and loss account, the first part, normally now we summarize and show only the income, the turnover, then direct expenses, cost of sales, then profit. Earlier we used to show the opening stock, add purchases, less closing stock, then arrive the cost of sales. Likewise, we used to show those details also earlier. Right. Now, this section 13 explain that part. Actually, there's no magic in this. Anybody who knows double entry bookkeeping, who knows accountancy or bookkeeping and accountancy, we do this part. We start with opening stock, then add purchases, then deduct the closing stock. Right. That's what they are explaining in that section. Then section 14, we said various improvement costs of property, plant and equipment, that is depreciable asset. Now, earlier even the repairs were covered. Now the repair word is not there. Therefore, repair, no limitation. You can claim the entire repair. But improvements, it looks like capital nature. That may be the reason why they have limited it. It is limited to certain given percentage of the tax written down value. But in a way, this is very unfair. You need more and more improvements when the asset is old. When the asset is old, the tax written down value is very small. When the tax written down value is very small, the allowable input also becoming smaller. Now, nobody can understand the logic behind this. But anyway, that's the law. I don't think even the legislators understood what they are legislating. That may be the reason. Otherwise, there's no reason for them to cover a thing like this, no? Right. They are on buildings, depreciable buildings, the improvement cost only up to 5% per annum you have to allow. In any other depreciable assets, 20% of the written down value. Written down value is allowable. Then whatever the component quantum, which you couldn't claim because of this limitation, the law says that you have to add that to the cost of the asset and claim in depreciation capital allowances. Now, as I explained that day, don't just go and add to the cost. You show it as a separate asset. Otherwise, in one day, you will face a lot of issues because now the asset may have already depreciated certain years. Then if you'll add into that, ultimately, there's a leftover part. Therefore, always it is better to under the same name like built-in improvements. Right. Then every year, if we are doing that, built-in improvement 23, 24. Then next one, built-in improvement 23, 24, 25. Likewise, you can maintain that separately. Then we discussed section 15, research and development expenses. Now this one, I noticed that a lot of IRD tax officials have not understood this section properly. And as a result, a lot of different views are there. Now we have to consider the substance of this section. What the legislator expected by legislating this, by incorporating, by inserting this section into the law. Research and development. It is very much important for a country's development. Otherwise, now some people, when somebody start doing some business, the other person also start in the same business. That is not a development. For development of a country, you need to do a lot of research and development and do that, right? And even market promotion. It is useless of your producing something. If market is not there, then you have to create a market, right? For that, to facilitate that, they have given that even the research and development expenses are capital nature, even in capital nature. Under this section, it is allowable. Then marketing and communication expenses, there's additional deduction of 100%. Additional deduction of 100% is there. As a result, ultimately, you are claiming 200% of the actual cost. Then we discussed the marketing and communication expenses, the nature of marketing and communication expenses. Now, some of these words are not fully described or fully interpreted. Now, marketing and communication expenses means any expense on market research. When it says market research, IRD might say something, some smaller coverage. But you need not to limit to that. As far as it is a market research, the substance is a market research for the purpose of marketing and communication. Then you should claim it. Then development of production of marketing and advertising, communication and all. Then advertising of mainstream media like TV and all. Then social media. Then product launches and campaign activities. Whenever you introduce a new product, you have to do a launch. Then that is maybe one time of that product. But campaign activities, every year you may be doing this campaign. Then it is allowable. Then development and printing of point of sale materials. Yeah, that is very much important. That is also allowed. Then section 16 we covered. That is a taxable, allowable depreciation. We call it as capital allowances. Capital allowances, there are 5 conditions to be fulfilled for you to get the entitlement of claiming that. You should be the owner. You should use it. Then at the end of the year, you should have the asset. Then you have to use it for the production of that person's income and that production of only business income. If you have fulfilled all 5 conditions, you are entitled to claim the depreciation allowances, capital allowances, only if it is a depreciable asset. Depreciable asset. The depreciable asset is explained in 4th schedule. It is explained in 4th schedule, right? Then you have to follow that 4th schedule. And in addition to that, it is defined in section 195. The rates we discussed: building 5%, motor vehicles 20%, IT hardware 20%, machineries or plant machinery and equipment 20%. Intangible assets, if the lifetime is not known, indefinite lifetime, we don't know the time, then 5%. Then milking machines, 50%. Milking machines with the latest technology. Then claimable capital allowances cannot be deferred. Claimable capital allowances cannot be deferred. If you have fulfilled all 5 conditions, if it is a depreciable asset, and if you have fulfilled all 5 conditions, there's no option, you have to claim the capital allowances. Then depreciable asset, this definition also we covered. It is explained in section 195. Then, in addition to the normal depreciation, under section 2nd schedule and 6th schedule, 2nd schedule and 6th schedule, there are enhanced capital allowances. There are enhanced capital allowances. Then, in the case of the losses of a business, you can carry forward and claim later. Now, the law says, in the case of a business, the losses on realization of capital asset, and liabilities are deductible only up to the extent that the asset or debt obligation of the liability was for the purpose of an asset, in the production of income from the business, because now there the word business is highlighted. And in other case, the liability was incurred in production. Could you please mute? Could you please mute your mic? It's disturbing the others. Then financial cost. Financial cost, section 18. Financial cost, section 18. There are limitations. This is applicable to non-financial institutions only, with certain upper limits based on the share capital it is given. Based on the share capital and reserves it is given. As I explained, for this purpose, the reserve is always a positive balance. Because the word reserve is not defined, there's a case law in the appeal courts. They confirm that reserve, there can't be negative reserves. Therefore, if there are negative reserves in our accounts, we have to take it as 0. We have to take it as 0. Calculation formula they have given: financial cost of the year divided by value of the debt instruments multiplied by 4 times of capital and share capital and reserve. Any excess amount which we couldn't claim, you can carry forward to the next year and claim in the subsequent years. When you are claiming the subsequent years, if subsequent year there's no interest, you have to apply the previous year basis and take that same figure also. But
I have a question for you.
no, it's not much clear. Now, it should be only limited to the interest, maybe even the debt instrument. So that day we discussed, therefore I modified it, financial cost and debt instrument. I included that also because indirectly it covers both. Right. Then
Excuse me, I have a question for you. Hello.
yeah, please.
Yeah, when you say the thin capitalization, what we explained, capital plus reserve, if
Yeah,
the company have the negative reserve, in this formula, you are taking share capital into 4 times.
correct.
Am I right? As for the
Yeah, correct. You're correct.
So in that case, the share capital, since the reserve is minus, so
Yeah,
share capital 4 times. Reserve in the sense, are
correct.
you considering the revaluation and return earnings?
No, the law says other than revaluation reserve. Specifically, it is mentioned other than revaluation reserves, right? Therefore, you can't take revaluation reserves. Haven't I mentioned that here? Oh, I have overlooked to mention that, no?
No, it's not here.
Yeah, I have overlooked to mention that. I'll include that. Yeah.
So which means again I'm asking the same question. If the
Yeah,
return earnings minus negative mean, we can go for the stated capital into 4 times for this formula, thin capitalization rule.
correct, yeah.
Thank you.
Yeah, shouldn't consider the revaluation reserve. Good that you asked that question because I have overlooked to include that. Shouldn't consider the revaluation reserve. Then finance leases. Now, under the current law, when we go for a finance lease, the person who is taking the lease assume that that particular person is getting the ownership of the asset. On that basis, under the old act, we were claiming a thing called lease rental. Under the new act, we are not claiming the lease rental. Instead of that, we are claiming the interest component separately because we assume that it is like a bank loan. Interest component we claim separately. Then we claim the capital allowances separately. Leasing company can't depreciate now. Earlier, leasing company were permitted to depreciate the asset. Now the leasing companies can't depreciate it. Right. Then today's session, tax on special businesses. We'll move to that section. Before moving to that section, do you have any questions to ask?
So one more question on this. One more question.
Please.
One question on the investment side. Now, say we borrow and invest on a company. Let's say we acquire a company. Let's say control stake of a company.
Yeah.
And so that is not a business income, but the borrowing basically the borrowing cost will be basically the cost of our investment, isn't it?
Sorry, could you please repeat
For example, let's say we have a company, we are borrowing and we are investing on that money to acquire another company. Let's say a controlling stake of another company, another entity.
Yes, of another company. Okay.
Yeah, basically controlling stake. May not be listed. Let's say a private company.
Okay, no problem.
Okay, so that borrowing cost cannot be deducted as a production of income.
Okay.
Yeah. Okay.
Depends.
So that
Depends.
Yes.
Right. Okay. For the time being, we'll say not allowable.
Not allowable. So then it will be going as a cost of our investment, isn't it? Under the investment income, investment expenses, isn't it?
Actually, that depends. Now, suppose your company's business is investing in other places.
Right. Okay.
That means your company's business is investment.
Okay.
If
right.
your company's business is investment, this
Okay.
is a business transaction.
Right. Understood.
right?
Okay.
Then if your company's business is manufacturing, we'll say manufacturing
Right.
and exporting.
Okay.
But as you had additional money, profit, you gone and invested in some other company shares.
Right.
Now, in
Okay.
that case, you are investing as an investment.
Right.
You are buying these shares as an investment. Therefore, first we have to decide the intention of making that investment, whether it is as an investment or as a business, right? Then depending on that only we have to apply the tax law. Now, either case, whether it is a business accessible income from business or whether it is accessible income from investment, either case, the cost of that investment, the interest cost on that borrowing is allowable.
Allowable
Borrowing cost
under
is allowable.
under business.
Section 11. Under
easy.
section 11,
okay.
because it is an expenditure incurred in production of income of a business or investment. Right? Section 11 covers business as well as investment. Therefore, under section 11, if it is an expenditure incurred in production of that income, then it is allowable. Right?
Okay.
Now, but section 12, the limitation is there. Section 12 says, if you not utilize it for the business or the purpose, then you are not eligible. That is okay, no, because section 11, it has to be for the production of that income.
Understood.
Therefore, the interest, whether it is for business source or whether it is for investment source, the loan interest is allowable. No problem.
Either case, you can deduct the interest expense in either case against your business income, isn't it?
No, not business income, that particular income.
That
particular income mean if it is a business income, yes, in arriving of the accessible income from business. If it is income, the investment source, to arrive the accessible income from investment.
Okay. Now the accessible income from the investment is usually dividends, no?
Right. That depends. Right.
Okay, so
in your case, you said investing in shares. Now the problem.
Shares of another company, yes.
Right. Now the problem, if it is shares of another company, you are eligible to, now I said you are eligible to claim this interest cost to arrive the accessible income from that particular source. Now your source is investment. And under investment, dividend, the withholding tax is a final tax.
Exactly.
When it becomes a final tax, to arrive the accessible income of that, you can allow. But the problem, there's no benefit because you can't go and allow that under the business category then. Or any other category, any other item you can't set off. Now, very recently, also last week, I finalized a set of accounts like that. The same situation, that's an investment company. In a group of companies, there's a small investment company.
So essentially, if you're let's say, manufacturing company, we are into exports as well, but you're buying shares of another company, which is not related to your business, so that your source will become dividends, which is a final tax at WST, so you need to pay. But your borrowing cost also you can't claim because you don't have a kind of income, right?
Yeah, you can't claim from any other thing. You can claim from that source, but it is useless to claim from that source because that source is a final tax.
Right. Okay. So if you look at another scenario, right? I don't know whether I'm taking your time.
No, that's okay. I'm so happy.
You have a company. You are into let's say you're apparel manufacturer. Right. You're buying let's say you're buying a company that is manufacturing let's say corrugated cartons. That is backward integration.
Yeah.
So that
Yeah.
is
Okay.
investment or business.
Yeah. Now, by seeing what has happened to tile industry in Sri Lanka, the Lanka Tiles and Rosale,
Yeah.
both bought over by same party, the major shares. As a result, that is to have a monopoly, but they couldn't establish a monopoly. They managed to establish a oligopoly because another player also came into the market. Even that player is not doing at that level, right? Anyway, now then it may be, now we'll say Rosale bought over Lanka Tiles. Why Rosale? Now, if Rosale bought over the Lanka Tiles shares, why Rosale is buying the Lanka Tile shares? To establish a better market, no? Then, in their case, I think it is more towards business.
Right. Okay.
Right. Now, in their, to establish, to secure their business, they have gone and invested.
Understood.
Now, suppose these individuals, now in that case, mainly individuals bought, no? Why the now when the same individual buy the shares of two companies, then the shareholder is that individual. Now, in the case of individual, it is not a business, no? It is an investment. Now, in that case, it is an investment. Now, if one company gone and invested in another company, we have to evaluate that and see. Because now in this business definition category also, because in one item it says, section 6, subsection 2, amounts derived that are effectively connected with the business. Now, in the earlier case, if Rosale bought over the shares of Lanka Tiles, that is effectively connected with the business. But if when Mr. Pereira bought Lanka Tiles as well as Rosale shares, we can't say that it is effectively connected with the business. For him, it is investment.
Right. But if you go and buy a company that is supplying you the raw materials, it can be treated as business, isn't it?
Correct. Yeah.
So like vertical integration or backward integration.
Yeah, vertical backward into yeah.
Right. Okay. And thank you very much.
Are there any other questions? Right now, tax on special businesses. There are few businesses I have identified separately. Leasing companies or installment hire purchase sellers, hire purchase basis sellers and leasing companies. Now, they are not like old act, as I explained. For them, when they sell an asset on finance leasing, thereafter they can't depreciate that particular asset. We have to assume that they sold it they sold it. The right they have transferred to the other party. We have to assume for tax purposes. Then in that case, we have to assume they sold it on credit basis. For the credit what they have given, they are getting some interest. Therefore, they have to record the interest income separately. Interest income, they have to record separate. If they have a profit on that particular asset, normally they are not keeping profit. When the vehicle price is 20 million, they sell it for 20 million. They buy it for 20 and sell it for 20 million. Because their business is leasing. Right? In that case, their income is interest. But they can't depreciate, they can't claim the capital allowances. Then hire purchase also, the sellers are also in the same boat. Then the next one, in long-term contract businesses. Now, some long-term contracts, suddenly the contractee might cancel the project. Then contractor may be losing heavily. Because I know this LRT train service in Sri Lanka, we were giving the accounting, auditing, taxation services to them. While they are having almost about 175 professionals working on that for designing work, while they were having almost 175 professionals working on designing of that project, due to some other reasons, especially corruptions, the government cancelled the project. Cancelled the project. Now, in early years, after about 1.5 years only, they cancelled it. Early years, they recognize profit because under long-term contract, we have to follow the accounting standard stage of completion method. Stage of completion method. By applying stage of completion method, they have recognized some profit in the previous year. Suddenly, in the second year or third year, they cancel the project. When they cancel the project, it is not an easy job. Lot of that. Now, I know they had some building contracts, building agreements, the rent agreements. At Rajagiriya, one building, then WTC, another building, another block. They had long-term rent agreements. Ultimately, they lost heavily on all these things. They can't just because today government cancel it, they can't send the employees tomorrow. No. They have to do a lot of closing down activities. Each took a lot of time and cost. Now, ultimately, that year, they ended up with huge loss. Now, in a situation like that, there's no future also. Right? There's no future. Ultimately, what has happened? They, in the first year, they recorded a good profit and paid tax. In the second year, huge loss. There's no future. That means they can't claim this loss in future. Therefore, they can go back and amend the previous year's tax return and claim the loss. Right? They can go to the previous year or years and amend the returns.
So up to
and
how
claim.
many years we can go?
There's no limitation. There's no limitation. Law is silence on that.
I mean, for any number of years till we recover the whole loss, we can go back.
Yeah. If there's a history, if there's no history, now in their case, we'll say first year they recorded 100 million profit, we'll say. Second year, they ended up with 150 million loss, we'll say. Actually, that is what, not, these figures are not correct, but this is what has happened to LRT train service. Right? Then go back and claim 100 million. Balance 50 million, there's no way of claiming. There's no future. In the history, there wasn't that much of profit. Then can't help. Anyway, it's a loss. Right. Then, in life insurance businesses, taxable income calculation is, there's a formula. Now, life insurance, when we pay up our insurance premium, that insurance premium contain future saving as well as risk coverage. Both are included in a assurance policy. Life insurance, though we call it as life insurance, is assurance policy. When it comes to an assurance policy, after the time period, the insurer is getting an assured amount, minimum assured amount. That is why we call it as assurance policy. Those are not insurance policies. Those are assurance policy. In the case of assurance policies, that is only life insurance, not for any other thing, only for life. Then the premium includes capital saving for the future as well as risk coverage. Therefore, this is how that company should recognize for their tax purposes. The profit. The business taxable income is summation of surplus distributed to their shareholder. That company, insurance company, is shareholders. Against what? From policyholders' fund. Now, in the case of assurance policies, they have to maintain, because insurance monitoring board is there, no? Under the monitoring board, there's a criteria, right? Then they have to maintain policyholders' fund account, right? Shareholders from policyholders' fund and investment income. Right? That means now out of this policyholders' fund, if they are distributing something to their shareholders, that component is a profit. In addition to that, this policyholders' funds, they go and invest in various places. Out of that, they are getting some investment income. That investment income also, if they'll utilize that investment income to give dividends to their shareholders, then that is also considered as profit of that company, profit of the insurance company for tax purposes. Less, now when we total up these two, from that they can deduct expenses incurred in production of income. Expenses incurred in production of income. Right. Now, this investment income, out of the investment income, whether they declared a dividend or not, it is a taxable profit. Right, that part. Now, this the word "and" in the law is little bit misleading. Right, these two are two independent things. These two are two independent things. Surplus distributed out of the policyholders' fund is one item. That is surplus distributed. Then the second one, the surplus part is not applicable for that. That is investment income out of policyholders' fund, less expenses incurred in production of income. Anyway, the law is little misleading, right? Summation of, yeah. How to improve this note? Yes, I can understand now when I am explaining, I also realize that there's a misleading situation in the law because I have copied down the law wordings. We can put it like this. 1, yeah, if we'll put it like this, then you will be able to understand. Otherwise, it is misleading. Yeah, we'll put it like this. In life insurance business, the taxable income is the summation of, number 1, surplus distributed to the policyholders' fund, and second item, investment income out of the policyholders' fund, out of the policyholders, right? Okay. Are there any questions? Do you have any questions? Right. Now you can understand because two items are separate. Then unit trust business. Under the unit trust business, what they are doing, they collect funds from other investors. Now, I am not very much familiar with share market investment. We'll say treasury bill investment, any other investment, I am not knowledgeable much. I'm so busy with my other professional work. Therefore, even I have knowledge, I'm reluctant to go and do my investment on my own. Then what I can do? I can go and invest that money, pool that money in a unit trust. Then unit trust has educated investment advisors, analyzing people and advising people. They get together and take decisions and go and invest in various places. Then by doing that, unit trust is making some profits, interest or whatever the profits, dividend or whatever the profit out of that. Then what the unit trust company does, they keep a margin for them and distribute the balance to the people who has pooled this money. Therefore, the people who pool this money, we call as the money by then when they invest to show their ownership percentage, ownership component, we call it as units. Now, suppose this ABC Unit Trust PLC, we'll say ABC Unit Trust PLC. Then they, depending on the total investment, we'll say total investment, they divide into units, 1 million units. Then I can go and buy 2-3 units even. Then subsequently, originally, if everybody invested at the beginning 1 million units, they invested at 100 rupee each. Then total investment is 100 million. Then first year they have done very well. They earn another 12 million. Now the value of the unit trust is 112 million. Out of that, they keep, we'll say, out of the earning, they keep 25%, we'll say. Balance 75%, they give to the people who invested. Now, investors' value is 100 million plus 7.5 million, 107.5 million. Then now, 1 unit's value is earlier invested at 100, now 107.50. That is how it is happening. Very in simple way, that is how it's happening. If it is a purely a unit trust. Right. Now, therefore, when the unit trust is pool of money, no? Pool of our money. Therefore, originally, the government has given lower tax rate for them. But subsequently, they change it. Now, no lower tax rate. Even for unit trust, the 30% standard tax rate applies. Earlier, there was a thing called eligible investment. If they go and do the investment in this eligible category, they were enjoying, once they were enjoying 24% tax rate, then subsequently 18% tax rate, but now again 30%. Now, therefore, this eligible investment story is not applicable now because there's no benefit out of that. Right. Then now the problem in the market.
Question on unit trust.
Unit trust, yes. If we're going to invest the money in unit trust, currently unit trust is not liable under withholding tax. Am I right? Whatever unit trust income you're generating. Because I'm investing in unit trust.
That means if I'll invest in unit trust and get a return. Are they? No, they can't deduct because they are not paying me interest.
Okay. When they're withdrawing the money from the unit trust, sir, for example, I invest 1 lakh rupees. When they're withdrawing with the interest, I'm getting 120,000. So the 20,000 profit is there. That is going to tax on the CGT or CST?
Now that depends, right? Now the problem, actually there's no clear application on this, right? Still there's no clear application. Why? Now, instead of unit trust, lot of asset management, fund management companies are operating. Right, in the market, fund management companies are there. It's same type of operation, but those are not unit trusts. But they are also calling, when we go and invest, they are also calling as units. In certain cases, they call it as units. Certain investment, the restricted investment, that unit story is not there. But when it is open investment, that investment management company can go and invest wherever they want. In those cases, they call it as units. That means they apply the unit trust concept for that. Now,
So in that case, if I'm going to withdraw the money from the particular unit trust company, I invest 100,000. With the interest, I'm getting 120,000. Okay.
Yeah, anyway, you are getting 120.
Yes, the 20,000 go to taxable under capital gain tax.
That is the problem. Now, if you have invested, if you have a personal capacity, if you have invested, it is not your business, no. It is your investment. In the case of, now, the source of income is investment. When it comes to investment, you have a room for you to argue that it is a capital gain. Investment capital gain. It is a capital asset. When we see the definition of capital asset, this is financial assets. It's a financial asset. As a result, it is an investment capital gain. When it comes to investment capital gain, you can argue your tax rate is only 10%. But IRD is arguing, no, depending on the period, we have to calculate interest component based on the WPLR rate. Now, suppose you got 120, they are trying to calculate WPLR rate, suppose 8% into 2 years, then 16,000, then you 16,000 out of 20,000, they are trying to say 16,000 is your interest income, only the excess 4,000 is your capital gain. To me, there's no base on that argument. Even they don't know the base. They are just arguing. It's very easy, according to current system of the country, with the system of the laws, they do whatever they want.
Well, actually, sir, the unit trust monies are they park in the treasury bills and treasury bonds. So we know the treasury bills and bond rate, for example, it's come to 8 to 9%. So how come if we take the current AWPR, say 10% mean, how can IRD can argue on that they are working with AWPR base?
Yeah, very good argument. Now, unit trust and unit trust, mainly they go and invest, that's true, mainly they may be investing in treasury bill, treasury bond. But some unit trust, their major investment is in share market. Now, it's a mix, right? It's a mix. Now, anyway, as you said, if they are investing in treasury bill, treasury bond, why don't we take that rate? Nowadays, for so many weeks, the rate is roughly about 8%. Right? It is not changing. These days, it is 8%. Right? If it is a situation, we should argue, no, it should be 8%. Now, my argument, have we deposited money somewhere to get interest? No. We can't say that suppose suddenly this particular unit trust has invested in share market also. Suddenly share market crashed. Today the unit price is 120. Tomorrow the unit price may be even 99. What will happen? I bought at 100. Now today 120. Tomorrow 99. What will be the situation? Therefore, there's no guaranteed in unit trust. There's no guaranteed return. No guaranteed return. These fund managers, they are guaranteeing certain returns because they also are not unit trusts.
So in that
Right.
case, can you exempt from the taxable income? So there's no proper rules or anything. It's going to benefit the output taxpayers.
I noticed recently I saw HNB, HNB Wealth Management or whatever the HNB, that company. They have given a declaration to one of my clients, breaking their income into 4 categories. It says through share market, this much. Through treasury bills and treasury bonds and bank deposit, this much. Then likewise, they have broken that into, then in addition to that, realized gain this much. Now, likewise, they have categorized it. I can't understand how they have categorized it. But these fund managers, when you invest in fund managers, you have option to select what type of investments are permitted by yourself. If you have permitted only share market, that is one category. If you have permitted only treasury bills and treasury bonds, another way. Therefore, depending on that option also, we have to consider that option also in arriving, in deciding of the tax. But to me, we can argue in the unit trust, we can argue that it is a capital gain. Right? Now, if it is myself, I argue that it is a capital gain. Then in the year disposed, the capital gain is realized. Then on that realized capital gain, I had to pay 10% tax. If my investor, the investor is a company, even capital gain, the rate is 30%. Only thing, as I explained, there's no clear idea on this.
So I also have another question when it comes to unit trust. Let's say I'm running a business. I have excess funds and I park in a, let's say, unit trust fund. And so that fund have invested on fixed income, so interest bearing instruments.
Okay.
Right. Now I get a return, let's say, which is predominantly driven by interest. So I will treat it as interest income. And but the company that to whom that money has been invested, let's say they have invested that particular money on a debenture or something like that, and withholding tax has been deducted at the source.
Yeah.
Before remitting my return.
Yeah.
Now my question is, can we claim that WHT as advance tax?
To me, you can't.
Mm-hmm.
Because you have a contract with that in fund manager, that is one contract. Fund manager is investing that in another place, that is another contract.
Right.
Therefore, in the secondary contract, if there's a withholding tax, that tax to be enjoyed by that entity, fund manager. They can't pass on to the other party.
Right.
But the way I notice this confirmation what they have given, I notice that share market things they have separated.
Yeah.
That means share market thing, of course, is okay.
Straightforward.
Because as per our the tax policy, the policy behind the tax law, a company's profit should not be taxed more than 2 times. On the hand of the company, 30%. On the hand of the investor, a final tax of 15% dividend tax. When you declare a dividend out of the dividend received, no more tax. That is the policy on this share market investments. Dividend. Therefore, with that, I think if it is in shares, that should be the way. But actually, now this area is not clear to anybody. Biggest issue, non-unit trust are calling something as units. If you see NDB wealth, in certain type of investment, they call it as units. That unit is not the real unit trust units. Therefore, it's misleading. But every day you can see the value of your investment. Now, I invested, we'll say 1 million. Today, today value is 1.1 million. Then if it is 1.1 million, if I want to, I can ask 1.1 million and transfer my units to that company, I can realize it. But if I'll wait till tomorrow, I might get little more. Everything depends. Right. Anyway, it's not much clear. Right. Now, if I'll come back to the subject matter, gain and profit earned in foreign currency by providing services. Earlier, it was exempted. Now, with effect from 1st April 2025, it is liable at the rate of 15%. Earlier, when you provide services to be consumed outside Sri Lanka, rendered services to be consumed outside Sri Lanka, it was totally tax exempted. There are 4 conditions. As far as you meet all 4 conditions, at that time it was exempted. It has to be a service, then consumed in abroad, then remittance in foreign currency, then 4th, remitted through a bank. You can get down this money into your rupee account. That is not prohibited. But that money from overseas to your bank account, it should come in foreign currency. Then the bank, you have to get a letter from the bank confirming that they have received in foreign currency and converted to rupees and deposited. Then no problem. If the foreign party transferred this money from one of their rupee account in Sri Lanka, you can't enjoy that. You are in a bad wicket. Because that is not remitted to Sri Lanka in foreign currency, no? Then you can't do that. Then, in addition to that, any foreign source is also exempted from this. Now, then, here O, that's why O derived from foreign source. That means now ultimately services they have covered separately and foreign any other source they have covered separately. That means if you go abroad, Maldives, and do a construction project and bring that money to Sri Lanka, that's a foreign source income. Then still you were enjoying 0% tax, no tax exemption. Now it is liable for 15% tax. In the case of individual, this 15% is the maximum tax rate. You can enjoy 6% if you don't have any other income, like anyway, it's slab rates. But in any other case, entities, it is flat rate of 15%. This was covering under section item U3, item U3 of the 3rd schedule. This was covering under item U3 of the third schedule. That was the section. Now, anyway, that section, the validity is over. Now, no validity. Right. Then, for income tax rates applicable, now we can see what are the income tax rates. I have given that in paragraph 8. We will see that later. Now, we will move to losses. Business and investment losses. Business and investment. Limitation of claiming business and investment losses are as follows. Limitation of claiming. Now, claiming both, not only business, it is business as well as investment losses. Then both type of losses you can claim. These are the limitations. Business losses you can claim could be deducted up to 100% of the business income plus investment income. No limitation. You can set off from the investment income also. However, again, the capital gain, investment capital gain, you can't do that. You can't set off against the investment capital. Then the person may choose the income calculation, or calculations in which an unrelieved loss or part of the loss is deducted. Right? That means you claim in current year, then any unclaimed amount you can carry forward to next year. Except investment capital gain, right? Now, that is also important. Except against investment capital gain. You can claim no limitations. Then deductible losses. Now, as for the law, you can deduct. Deductible losses shall be deducted. Shall be deducted. That means no option. Whether you like it or not, you have to deduct. Because some people might try not to deduct in current year. We'll say in 1 year, the income tax rates were 14%. Next year, 30%. Now, in 14% rate year, you just avoid claiming to get the benefit in the subsequent year. That you can't do. Then, however, now investment losses, there's a limitation. Business losses, no limitation. However, the investment losses could be set off only against investment income. In the case of investment losses, you can't go and set off against the capital, the business losses, right? Or business profits. You have to set off against the investment income. Whatever the unclaimed amount, you can carry forward to next 6 years. With 6 years, carry forward facility. That I have explained subsequently also. In both cases, this carry forward facility, they are 6 years. Then, what may be the reason why they are not allowing business, the investment losses against the other thing? What may be the reason? What do you feel? The legislator has limited it. What may be the reason? Give me a minute. Yeah, you can explain what is the limit, what is that reason? Yeah, if you know the reason, then it will be easy for you to remember this. I think the reason may be not like in business, investment category, the possibility or probability of ending up of a loss is at a greater level. Possibility of ending up with a loss, that's a big risk. That may be the reason why they have not allowed that against the business. Balance unrelieved loss, whether business or investment, could be carried forward for next 6 years for claiming. 6-year carry forward facility is there. Even here, 6-year carry forward facility is there. 6 years carry forward facility is there. Even in that case, it is there. Do you have any questions?
So I have a small question on this. Assuming 1 year, this year, 24-25, I have an investment loss. Okay. But
Okay.
investment income tax rate is 30%. But there
Yeah.
are tax investment loss brought forward in 2023-24, where it is 14%. Can I offset the 24-25 investment loss against the previous year, where the tax rates are lesser than the current year?
Yeah, that's possible. Why? The tax rates change of tax rate is not our responsibility, no. Beyond our control. This change of tax rates are beyond our control. Only control was we selected some MPs and sent to the parliament. They got together and passed a law. That's all. Our only connection is that. Voting for these people. Whatever the people, whoever the politicians. That's all what we did. Then, anyway, their passing of the legislation is beyond our control. As a result, we shouldn't be penalized by not allowing the claim. Therefore, we can claim it. No problem. Understood?
Yes, there's another one. If the business loss, you said 6 years can carry forward. 6 years means the loss we incurred plus 6 years, or we take total
6 years plus current year.
The loss
That
incurred
means next
plus
6. Yeah, next 6 years. What it says is next 6 years. Then current year, anyway, you are claiming. In addition to that, next 6 years also you can claim. Current year plus next 6 years. That means altogether 7 years.
7 years, correct.
Current year you can set off against any other business or investment.
Thank you, sir. Thank you. Understood.
So this is also linked to my previous question on investment. Basically, you borrow and invest on a company.
Yeah.
And that generates basically dividend income.
Yeah.
And in this case, your interest basically expense that you have borrowed will go in vain, no, after 6 years, because there's no income that you can set this off.
So the income is subject to a final withholding tax, no?
Exactly, exactly.
As a result, that means no, that means you claimed it, but
yes,
bottom line is no tax. Therefore, you didn't get any benefit.
Exactly. So when you're evaluating the investments, when you're evaluating the investment, and if you use borrowing as a source, I think probably we have to take that particular unclaimed cash flows also into that, no?
Definitely. In evaluation, you have to consider that also.
Right. Okay. Thank you.
Right. Then, as I mentioned earlier also, losses on long-term contracts, you can go back and claim it. You can go backward. This is a repeat thing I have given here also because it is relevant to losses. Then losses on incomes taxing at lower rates. could be set off against any business or investment income not taxing at a higher rate. Little while ago, I said no problem. But here, the law says you can't set off against the higher rate taxing category income. However, this is my explanation. However, with effect from 1st April 21, the brought forward business losses of a company, right, they're wrong. They have taken only company, right? Anyway, occurred during a period where a low tax rate was applicable under SME, can be set off against the subsequent non-SME period higher tax rated business or investment income. What about the individuals? It is not covered here. They have addressed only to this SME category entities. To be a SME, it has to be an entity. Now, they have covered only that. Because now, why at that time they have given some special concessions to SME to develop them and bring that up to a developed stage? When they developed with greater difficulties, incurring a lot of losses in the early years, they developed and reached more than 500 million turnover a year. Then it is a non-SME. Then it is not fair to say, no, you can't claim the brought forward losses. Because this SME identification has given in the tax law to promote the SME. If it is the situation, in tax angle, again, we shouldn't disturb them. Therefore, to be fair, they have covered that here. But my question, what about other individuals? Now, in 1 year, their tax rates was only up to 18%. Now, then they increase it to 36%. That part also they could have to cover here, but they have not covered it. But even they have not amended the law specifically to cover that, you can enjoy that. No problem, you can enjoy it. Because the rate changes is not your problem, beyond your control. Next, business losses, a loss in relation to a business where the tax rate has been subsequently increased. The losses incurred during the rate period will be allowed to claim subsequently disregarding the reduction of rate. Disregarding the subsequently increase, disregarding the reduction of the rate, that is wrong. Disregarding the increase of rate. Sorry, that's a mistake. Disregarding the increase of the rate. Subsequently increased. Now, under this, we can cover even individuals. Because here it is not limited to companies. Any persons. This is applicable for any person. This is applicable to any person. Next, investment losses, claimability of unrelieved investment loss. From last year, we brought forward investment loss. Current year, we claim in ability is limited to the subsequent 6 years. Subsequent 6 years, that is succeeding 6 years. When it says succeeding 6 years, current year plus next 6 years. From the year of assessment, it is incurred. Loss claim set off against the capital gains no investment capital gains be reduced by any loss. I explained that earlier. Then losses on exempt businesses could be set off only against the exempt business. That is fair, no? Because if the income is exempted, now as an example, we'll say, today I face this issue with a client. That client is having a service export company. Unfortunately, this service export company in 2024-25 ended up with a loss. Service export company in 2024-25, they have ended up with a loss. We'll say the loss was 1 million rupee. 25-26, definitely they'll be getting a profit. 25-26 next year, they'll be getting a profit. Can that 1 million carry forward to next year and enjoy it? Can't. Because this loss, they incurred or they realized that they got that loss in a year, it was exempted. As a result, they can't claim on a subsequent year. In that case, they can't claim in a subsequent year. Is it clear? Actually, this particular client discussed this issue with me today. I said, no, under the law, you can't do that. Next, finance lease business losses. Finance lease business losses could be set off against any business income, subject to above limitations. Even finance lease in business. Because why I included this under the old law, finance lease businesses, we were taxing finance lease businesses in a separate way. That is why I included this. Right? Normal other company like, we can tax it. Loss on financial instruments. Loss on financial instruments. On financial instruments, the probability of losing is also high. Therefore, Commissioner General has specified what to do. As specified by Commissioner General, such losses shall be set off against gain of financial instruments. Inland Revenue Act has given room for the Commissioner General to specify it. As a result, with that power, Commissioner General specified it. Then, if you incur a loss on a financial instrument, you can set off that only against on another financial instrument's profit, not from any other thing. You can download this gazette notification. Are there any questions up to now?
Okay, so on the last item that you discussed, loss on financial instrument, can you give an example?
Now we'll say listed debenture. There's a debenture which is listed, right? I bought it from the open market at 110 rupees. After a week, I wanted to sell it because I wanted some money. Then I sold it, but unfortunately, due to country situation, suddenly the prices came down. And now I bought at 110, I sold at 105. I incurred 5 rupee loss. That 5 rupee loss, you can set off against any other gain on financial instruments.
It has to be debentures or it could be shares?
Yeah, no, any financial instrument.
Okay.
But shares in the
you can't because it's capital gain,
they are shares, listed shares, the capital gain is exempted. Therefore, you can't use that. Non-listed shares, yes, you can use.
Right. Okay. Thank you very much.
Today, I'm so happy. Lot of clarification, lot of questions asked by participants. I'm so happy with that. That is how you should Act. Right. Now we'll move to exempted and excluded income and reliefs on income taxes. Under income tax law, there are exemptions. There were a lot of exemptions. Now only very few exemptions are there. And some reliefs are there. Reliefs, this type of reliefs, certain reliefs are there that mean lower tax rates and all, and certain deductions and all. Some especially lower tax rate. Now, as an example, when we are doing services through local market, we are paying tax maybe by a company 30%. But when that company exports service, liability is at the rate of 15% now. It's a concessionary rate. Right. Now I categorize this into three categories. These exemptions and concessions are under employment income, business income, investment income. Employment income I'm not going to discuss because Mr. Saman is covered that. Then business income I have categorized into two: exemptions under Strategic Development Project Act and exemptions under Inland Revenue Act. Now, no more new exemptions under the BOI. That is the very reason why I have not included the BOI part here. Then exemptions on investment income I have categorized into three for easy understanding: on dividends, on interest, on any other. This is just for easy understanding. Then reliefs on income taxes. There are certain reliefs. Here the relief is not under that section 52 relief, right? I wonder whether I have used a wrong word. Relief. Yeah, it might mislead, no? Relief, what can I use? Concessions. Yeah, we can call it as concessions. I think that is better. Because in the tax law, another place, there's a technical term called relief, no? Therefore, we'll call it as concessions. Right. Concessions on income taxes. Post-COVID economic recovery special tax relief. Under that, this relief is there, right? Under that, the relief is there, right? Under each source of income, it is stated that when we take each accessible source of accessible income, it says excluding the exempt income. Therefore, it is stated as that the exempt income, exempt amounts and payments subject to final withholding taxes are excluded. Hence, all exempted incomes are excluded from all sources of accessible income, which results that in arriving at accessible income of each source, the exemption incomes, if any, on that source to be deducted. Please refer the income tax computation format given under 142 above. We have explained that, we discussed that. Now we'll move to exemptions on business income. We better cover the exemptions on business income under Strategic Development Project. Now, the Strategic Development Project Act is a 2008 Act. This is totally a politicized act. The government at that time wanted to take the spoon into their hand to control these investments for various corruptions, actually. Now, when they have the spoon with them, they can ask some money and serve the way the people are giving those benefits, rewards. That is what has happened. This is totally a politicized thing, and which was very much set up under the BOI Act. BOI Act, they took over the BOI authority by this Ministry of Finance. the Minister of Finance, the President of the country. That is what has happened. And it has, it created a lot of corruptions in Sri Lanka. Now, as a result, after a government change, subsequent government cancelled the operation of the act. For some time, they suspended the operation of that. Again, with the government change, again, after the change, restarted the operations. Now, still, this is there, everything depending on the approval. Now, we'll see the approval process. Strategic Development Project Act is reactivated for new projects after several years and is in operation now. Now, what is the process? BOI, first step, BOI identify a project as Strategic Development Project with the consultation of the line minister. See, with the consultation of the line minister. That means even the job is assigned to BOI, it is managed by whom? Line minister. Then second thing, after that, gazette it. Once they recognize, should gazette it. Who is gazetting? By the minister in charge of investment. In Sri Lanka, president. President go and gazette it in the capacity of finance minister. Then after 30 days of that gazetting, get it after 30 days, put that into the cabinet and get it approved. As you know, in our cabinet, nobody in previously, even now, maybe people are not much evaluating these things. When that particular party puts something into the cabinet, normally they approve it. They approve it. Blindly they approve it. Right? Because that is how it's happening. Then this approval, even the condition is their cabinet approval, is useless. President, being the finance minister, can influence that. Then within 6 weeks of cabinet approval, that order be gazetted. That cabinet approval to be gazetted. It's easy, it's a formality. Within 3 months of that gazetting, get it approved by the parliament. Now, they have given the authority to parliament. What the use of giving the authority to parliament? Ultimately, president can influence the parliament and get it approved. That is practically, that is what's happening. And as a result, so many malpractices happened in the past, which has badly affected to the economy of the country. Right? Then, under the Strategic Development Project Act, can grant exemptions under the exemptions for a period of up to period of 25 years. See, they can go up to 25 years exemption. Then this act can supersede another 12 acts. See the authority of this act. See the authority with the Minister of Finance, the President of the country. Can influence and do whatever he wants. Then what are the acts? Out of these 12 acts, except one act, which is Sri Lanka Export Development Act. Except that act, all the acts are connected with tax laws. That's the worst thing. Inland Revenue Act, VAT Act, Finance Act, Excise Special Provision Act, ESC Act, Debit Tax Act, Custom Ordinance, NBT Act, PAL, then betting and gaming. See, almost all taxes are there in this. That super luxury tax is not here. At that time, it was not there. Otherwise, that also would have been included here. See how legally they have done the corruptions, right? Now this law itself violating the human rights by giving this authority to one person is not correct, right? Anyway, subsequently, these approvals are very much limited, right? Now, newly they have given the authority to ports, the Port City Act. Now, Port City Act also, very recently, they have announced some changes. And under that, now they have limited the 25 years tax holiday. As far as I know, except for 18 cabinet approval, other new approvals won't get lengthy time period exemptions. But the problem, what the use of having that type of heavy investment without making use of that? When we put all taxes, what will happen? People will not come to, FDI people will not come to Sri Lanka for investment. Because our tax rate is 30%, whereas Singapore, India, Dubai and all, either tax rate is 0 or very low. They will move to those countries, right? In certain countries, no dividend tax. Then they will go there. Now, with that situation, for genuine investments, we should give tax holidays for genuine. Right. Then we'll move to the Inland Revenue Act exemptions. Right. Gain made by entity. Now these things I'm not going to read everything. It is useless. At the end of this business category, I have given a summary. I'll move to the summary and try to explain it because I know everybody are very busy. As a result, I prepared a summary. I'll go to the summary and explain it. This is the summary. Summary of tax holidays on business explained above. You all can read the notes separately, but I'll explain through this. Now, what's the industry or legislation? The section of the law and all. To whom this is applicable, whether it is applicable to resident people and non-resident also. Resident or non-resident. Resident or non-resident. Then the effective date, from which date, then exemption period, up to which date the exemption is there. All these are headings I have given. Now, majority of these exemptions are no more over. Right. Strategic Development Project Act. For both resident and non-resident people, it is there. The holiday period is as approved by the Parliament, approved as approved. Then the tax exemption period is also as approved. Depending on the approval, we have to see the approval document, agreement. Then realization of land and building sold to real estate investment trust. Real estate investment trust. Sometime back in 2021, government realized with COVID and all, government realized a lot of property developers are in a bad shape. And ultimately, the people whom they have paid advances on property, they are in a bad shape. As a result, by seeing this issue, government thought that they have to do something for this type of investment. Because people advance money to property developers. To secure these people, prospective buyers of these apartments, government thought to form, allow under the tax law to allow a company, any company to go and register in the Colombo Stock Exchange as a real estate investment trust. Real estate investment trust. Now, if a company registered in the Colombo Stock Exchange, labeling as real estate investment trust, then that real estate, when we deal with that real estate investment trust or that real estate investment trust business were exempted for tax, They prepared the tax law to suit with this. But unfortunately, none of a rate company registered in Colombo Stock Exchange, none of a company listed in the Colombo Stock Exchange as real estate investment trust. Therefore, I have mentioned inactive. This is not inactive. Nobody registered. Then non-resident certain supply of service and service income from Sri Lankan Airlines. When non-residents supply services to Sri Lankan Airlines, it is still exempted. Still it is open. Only for non-resident people. Next, non-residents income on government projects, not for us. Non-residents income on government projects which are approved by the minister and 100% funded with foreign grants. Now, this is also another area where our politicians manipulated. They used to, in the history, they use now when we need to do a government project, infrastructure project, we'll say we need 100 million US dollars for that project. Then they make this project construction people liable to tax. Then when overseas companies come and do this project in Sri Lanka, they have to pay 30% tax on their profit. We'll say the project value is 100 million. They expect 10% margin, we'll say. When they expect 10% on 100 million, they expect 10 million US dollar profit on this. When they want 10 million profit, after paying 30% tax, they have to take 10 million as equivalent to 70% of that. That means almost 13.5 million. Ultimately, they jack up the project cost by another 3.5 million US dollars. Government pay them 3.5 million additionally pay. By how? By obtaining overseas loans. Now, ultimately, what the government is doing? Obtaining, as a country, we are obtaining additional $3.5 million from overseas to finance what? Not to the project, to finance the government. Now, as a result, IMF was totally against this. At last, they changed the tax law to say, if the project is 100% financed with foreign grants and it is a government project, the person who is doing the project is totally exempted from tax in Sri Lanka. Still, it is there. Always I am explaining with the logic behind this. Then agro-farming. Agro-farming sector, there was an exemption up to 31st March 2024. 5 years from 1st April 2019, now it is over. The word agro-farming is defined in our tax law. Is it defined? If we are covered with agro-farming, that total income was exempted for both type of people. Now, no more. This is one of my specialized field, agriculture, taxing of agriculture sector. Therefore, I would like to add little bit to this. Now, the word agro-farming is defined in the tax law. right? What it says, the tillage of soil and cultivation of land with plants of any description, cultivation in greenhouse, beekeeping, rearing fish, shrimp farming, animal husbandry, see animal husbandry is there, poultry farms, hatchery, veterinary or artificial insemination services. This is mainly for dairy industry and all. All these are covered with agro farming. See, even poultry farming was exempted for 5 years in Sri Lanka. Animal husbandry, all animal husbandry was exempted. Then in addition to these things, now suppose you are doing animal husbandry, you or poultry farming, you rear broiler chicken, broiler broilers. But at the end, the consumer market is for the chicken and not for a live bird. It is for the chicken. That means what the use of running a farm if you can't meet the consumer market? Consumer market is for chicken. Then whatever the steps what we are taking to change your harvest to suit with the consumer market, those activities are also part and parcel of agro farming. Understood? That was the intention. Because the poultry farmer is there, then the growers are there. The consumers are there. Therefore, farmers should cater to the consumer. Keeping that in mind, they included this part also into the law, but this is not complete. The cleaning, sizing, sorting, grading, cutting or chilling of any produce produced out of any activity referred to in paragraph A by any person who is engaged in any such activity in preparation. This is the important thing. In preparation of such produce for the market, that means consumer requirement, but excludes the agro or food processing. Now here what has happened, as you know, our tax officials, their thinking pattern, the scope is very limited. They don't think about the substance of this transaction. Therefore, they highlighted this excludes agro or food processing. They said, if you are selling the live bird, it is exempted. If you will kill it, dress it, and sell as a whole chicken, it is liable. Right? They said, convert into whole chicken, cleaned, dressed whole chicken comes under processing. What to do? We can't give brain to them, no. That is how they have interpreted. Then the same thing happened in 2006 Act. I, on my own alone, fought with the IRD. At that time, all other professionals were accepted the IRD view, but I was not accepting. As a result, I fought with the IRD and went up to the courts level. At the Tax Appeal Commission, I won this agricultural case. Then each case, I had almost about 32 cases. I think about 10 cases or 12 cases went up to the Tax Appeal Commission. I won all these cases one by one. Then IRD appealed to the courts. As usual, they did the usual dirty thing. Normally they are harassing the taxpayers. As usual, to harass the taxpayers, they appeal to the tax appeal courts. And they marked as much as possible time for the judgment. Every day, they were asking time again and again. At last, the judges panel got upset, and one day the judges panel for the first case, judges panel said, no more postponement on such a next day, we are giving the determination. For each case, on the determination date, IRD came along with the Attorney General's people and withdrew their cases. In Sri Lanka, these are civil cases. Appellant can withdraw the cases at any time. With that facility, almost about 8 cases went up to the courts. Each case, after dragging as much as possible for about 2.5 years, they withdrew their cases. What to do? This dirty thing is happening to harass the taxpayers in Sri Lanka. It's widely happening, right? No sooner they know that they can't win, but what they did that is because they realize except 1% of the market, 99% of the taxpayers paid tax on that. Only about 1% didn't pay, because my clients may not be even 1%. I advise my client not to pay. Then, as a result, they thought that suppose I win the case, other people whom they have paid tax, they will ask for claim refunds. To avoid claiming refunds, because refund claiming, there's a time period. To delay that, they drag as much as possible. Now, anyway, under this law also, this issue was there, right? Then Agricultural Undertaking 2006 Act, as I explained, because my cases were under 2006 Act. Under that, those things also I highlighted here. I'm not going to explain any further on that. You all can leisurely read these things and try to understand. Then IT and enabled services, there was a tax exemption from 1st January 20 to 31st March 2023 for both people. Now it is not there. Then local and foreign services to be utilized outside Sri Lanka, that exemption recently they removed. Then any foreign source exemption also very recently they removed. Then vocational educational institution, they have given a tax exemption that was there only for 2 years. Now it is not there. If a vocational educational institution doubled their student base, because this vocational education is very much important for a country development. Therefore, they introduced that, but after 2 years, they canceled it. Then gold, gem jewelry export and business, as well as gem processing for export business, you process and give it to another person for export. Those businesses also, it was exempted for 2 years, now no more. Then non-residents, laboratory and standard certification services, this is non-resident. As a result, still it is there. As it is for non-residents, still it is open. Then recycling and sale of recycled construction material. Now in the construction industry, there are a lot of waste materials. They can recycle and use, especially these waste concrete parts and all, they can crush and produce sand or whatever it is. Then there was an exemption that was there only for 2 years. Then business commenced after successful vocational education. This is connected to these vocational education institutions. If an institution doubled their student base, they got this exemption. At the same time, to promote people to go for this vocational education, they gave this concession to students also. When a student joined to a vocational education student, after the vocational education, if you will start a business, with that knowledge, if you will start a business, you were getting tax holiday, but they limited it to 2 years. Then, in all these cases, I have given the section numbers. All these are third schedule, these section numbers. Boat and ship building by residents. This was there only for resident people. It was there only for 2 years. Then solar or wind power project, not less than 100 megawatts. Huge projects. Huge project that is about 60 million US dollar projects. 60 million upward, like. So 100 megawatts, that exemption was there only for 2 years. Then construct communication towers and install appliances. Yes, it is very much important for a country's development, communication. It is very much important. Therefore, to promote communication industry, they allow resident people to get this benefit, to go and construct communication towers and do various installation and services with relate to that. They were getting 2 years tax holiday. Then letting out of bonded warehouses for offshore businesses, there was a tax holiday. That is also, it was there only for 2 years. Now see, still open items. This one, laboratory certifications and all for foreigners. Then this open item, the government project thing also for foreigners. Then services to Sri Lankan airline, that is also open only for foreigners. There aren't any exemption. There aren't any exemption for us. No exemptions. Only 3 exemptions are continuing under the Inland Revenue Act. Those 3 are for foreigners. In addition to that, if we are to get an exemption, we have to go behind the president of the country, finance minister, and do whatever the things what we have to, and get the approval under Strategic Development Project Act. Right? That is the situation now. But now, in addition to these things, we have to bring the Port City Act also, because the Strategic Development Project Act also is also not much active. In a way, that's good, because this is not a good law for a country, right? Therefore, it is good that if it is not operating. Are there any questions on these things? Are there any questions on these things? Yeah, do you have any questions? As I can take another about 10 minutes, as I can take about another 10 minutes, I would like to move to the next part also. Exemptions on investment income. I have divided into 3: dividend income. And now in this case also, I'll go to the chart, the summary, and explain it. Then it is easy, because I need not read the entire note. I'll go to the summary. This is the summary. Dividend paid by a resident company, which are covered under item U3, item 00 of third schedule. There was an exemption only up to 30th September 22. Now no more exemption. Now no more exemption. Then dividend paid by a company. There were several exemptions, except one. Except these 2, others are not there. What are the open ones? If a dividend is paid to any person by a BOI registered company engaged in certain businesses as covered with Part 4 of the Finance Act, these are international market related activities. Still, that is There, we can read that and see, but only problem. Now, there can't be new exemptions because there won't be new BOI companies under the having this facility. Then this number 2 is to any person, any member out of the dividend received, that is valid for all of us. If a company is declaring the dividend out of the dividend received, then we need not to pay tax on that. Then the last one, to a member, non-resident member, to a non-resident member, if such dividend is paid prior to 1st January 23, that means that is also no more now. Then dividends and disposal gain of shares in a non-resident company, if I'll buy more than 10% of shares, of an overseas company, I am considered as major shareholder. If I am categorized as major shareholder by purchasing more than 10% or more, when I dispose those shares, the entire gain, when I bring the entire gain to Sri Lanka, it is capital gain tax-free. Then, while keeping it, if I'll get dividends, that is also tax-free. It is open yet. It is open. Then dividends and gains on realization of units or of real estate investment trust. It is useless to talk this because there wasn't any company in Sri Lanka under this category. Then this may be important. Interest earned by any charitable institution. Interest is exempted from tax, but there's a condition. Only if it applies for the purpose of providing care for children, the elderly or disabled in a home maintained by that institution. Then only you are getting the exemption. Next, interest earned by any person outside Sri Lanka. Any person outside Sri Lanka, not earning from another country. A person outside Sri Lanka, right? Overseas lenders. That's why the wording in the law is not clear. Therefore, I put as overseas lenders income by lending to Sri Lanka on any loan granted to any person in Sri Lanka, or a foreigner can give a loan to any person in Sri Lanka, maybe to an individual, I can obtain a loan, or my company can obtain a loan, or government can obtain a loan, or a bank can obtain a loan, right? Any case, if it is as far as it is a loan, the interest is tax-free for them. Interest is tax-free for them. Then interest earned by any person on foreign currency deposits. For any person, foreign currency type income, deposit interest income are exempted from tax. Next couple of things are also foreign currency things. Foreign currency special deposit accounts exempted. Then next one now, then interest earned by any welfare society. Welfare society. Now, no conditions. If the depositor is a welfare society, interest income is totally exempted. Then interest earned by any multinational company, if they'll keep that foreign deposit in a bank to finance the future imports. Now, multinational companies, after identifying the profit, they take off the profit from Sri Lanka. At that point, we are charging remittance tax. Now, if they'll keep that money without sending abroad, if they'll keep that money in Sri Lanka in a bank fixed in a foreign currency deposit account, they can utilize that money for future imports, no problem. Then they are getting that remittance tax is not there. This tax is remittance tax, right? This tax is remittance tax. this benefit is on remittance tax, right? Then they can enjoy that remittance tax. Then any interest discount or realization gain of a non-resident person, sovereign bonds, foreign currency sovereign bond exempted. Again, foreign currency, Sri Lankan sovereign bonds, foreign currency exempted. Again, realization of sovereign bonds by a commercial bank or authorized dealer making aggregate investment above 100 million US dollars. For these bankers, financial institution, it is exempted. Then interest or discount earned on or after 1st April 21 by any Samurdhi community bank. That means if a Samurdhi community bank go and invest in treasury bill and treasury bond, for them interest income is tax-free. There are two reasons for this. One is to help the Samurdhi Development Bank to come up. But main reason is not there. Government thought that Samurdhi Development Bank might misuse money and ultimately the depositors will be in trouble. To secure the deposit up to a certain level, they promoted this Samurdhi Development Bank to go and invest in government. Then part of their portfolio with the government. Then government can repay a percentage to the depositors. That is the main idea behind this. Next, any foreign source earned or derived in foreign currency and remitted through a bank to Sri Lanka, as I mentioned under the business category also, that exemption was there up to 31st March 25. Are there any questions up to now? Are there any questions up to now? Yeah. Do you have any questions up to now? Actually, I wanted to cover a few more, but I couldn't do that. Another 1.5, another page like, right? Are there any questions up to now?
No, sir.
Then there's an item 5.4, waiver of penalty and interest on investment capital gains. No penalty and interest be charged on delayed investment capital gain tax for the period from 1st October 22 to 8 May 23 of a company if settled on or before 30th June 23. Because government delayed to legalize the law. They announced, they gave public announcement they are exempting certain things. But they failed to legalize on time. And some companies, they paid money saying pending legalization of government prospective law. Public companies did that. Then after realizing the gravity of delay in this, the effect of delay in their law, they gave this concession for capital gain tax. This is only for that category. Next, exemptions on any other receipts, any other receipts. Any person, any sum received by any person from President Fund or National Defense Fund, it is totally exempted. On any person's hand, exempted. Then by any public corporation, out of funds voted by the parliament, from the consolidated fund or out of any loan arranged through the government, it is tax-free. What the use of charging from a public corporation for a thing like this? Therefore, they made it exempted. Next one, exemptions on remittance tax. As I explained earlier, now this is also another opening for these multinational companies or the people, the overseas investors invested in Sri Lanka. If an overseas investor invested in Sri Lanka, in that company, especially these branch officers, what will happen? After the profit, they remit their money abroad. Therefore, government said, if you'll wait without remitting that money for next 3 years, without remitting, if you retain that money in Sri Lanka for another 3 years, you are exempted from tax. But during that period, that means exempted means remittance tax. You need not to pay remittance tax. If you invest that money in Sri Lanka for next 3 years, you can invest that money to expand its business, to acquire shares or securities from Colombo Stock Exchange, or to acquire treasury bonds of Sri Lanka international sovereign bonds. Then the tax rate on remittance tax on such retained income is 0%. That means you need not to pay remittance tax. But you have to keep minimum of 3 years by investing in one of these 3 categories. Next one, IT relief on post-COVID-19 economic recovery special tax relief. Right. I'm not going to explain this in too much, but I'll give a small briefing of this and stop for the day. Under this, the sub-item 1 and 2 are meant for SME sectors. 1 and 2 are for SME sectors. Then number 3 is for any person, any taxpayer. Right. You better read this part. Now the time is 9:19. I shouldn't take any more time of you. Therefore, I'll stop at this point. But when you are participating for the session next day, please come with after reading this. What's my next day? Yeah, next day is 30th, no? 30th. Yeah, 30th I am available. On 30th, I will continue. After 30th, subsequent 2 days, I'll be out of the country, and as a result, I'll not be able to do. Mr. Saman will do that part. Yeah, saying that, I would like to wind up today's session. Do you have any more questions? Do you have any more questions? Right. That shows that there aren't any question for the time being, but you may be having some questions on the next day. Please come with more and more questions on the next day. Saying that, I would like to thank everybody. Special thank to the people who ask questions for everybody's benefit. And would like to wish everybody a good night. Good night.
Good night, sir.
Thank you, sir.
Good night.